I hate to say this because it sounds like I'm being such a defeatist, but I want to be a realist at the same time. And I've tried to tell people that I think we're just at a point where all we have are bad options as investors. That's it. So you can't try to figure out what's a quote unquote good investment because there are none. The only thing you have to do is try to figure out what's the least bad investment. And now that said, I think there could be some quote unquote good investments, but you got to get offshore. You got to look at, I think Russia's interesting. There's some investment opportunities in Africa that I think are interesting. But if you're just looking at the S&P 500 and bonds and gold and silver, and I would go so far as even to say Bitcoin, there's going into this environment, there's nothing that's a good investment, and not even Bitcoin, because if someone says, well, if everything crashes down, everyone's going to go into Bitcoin, maybe eventually, but not initially, because I think that Bitcoin is on the balance sheet of so many of these hedge funds that philosophically don't care about Bitcoin. They just want to make money. But they also, in a downturn, they would need liquidity. And as a student of financial history, you know that when we have a big downturn in the stock market, like the GFC, what sells off? Gold. Gold.
You dump anything that's retaining its value, right? So
anything where there's a bid. So if you got a bid, you're going to sell it because you have to have that liquidity. And that's exactly what we saw after Lehman Brothers. Now, what ends up happening is because of the policies that are enacted by the central planners, then gold rebounds and goes, and that's most likely what we'd see in Bitcoin as well. But it's definitely not a straight, from the lower left to the upper right with the price of Bitcoin in that environment, because it's heavy duty risk off. And then I'd also point out that going back to our wonky discussion, that the Eurodollar future curve did invert. And I won't go into the explanation of what it is, but the bottom line is it's very similar to the inversion on the Treasury yield curve. And for those of your viewers who might be a little more sophisticated, they know that when that yield curve inverts, the Treasury yield curve, there's a 90% plus chance that we get a recession in the next, call it, year and a half or so. I mean, you just go back to the 1940s, look at a chart, and every single time that thing inverts, we get a recession. And it's a similar outcome with the Eurodollar market. But what the Eurodollar future curve tells us is that the global economy is going to have big, big problems. At the very least, we're going to see a lot less economic activity globally. And I do think that it's interesting that the Eurodollar future curve started to invert when all of these, or not all, but a lot of these European countries came out with their new round of, let's just call them restrictions, lockdowns, etc. I think the Eurodollar, that's smart money. That's pretty much the smartest money in the world. I think they saw that and they're saying, okay, that's definitely going to be what we're going to have to deal with for the next, let's say, 2 years globally. And that means less goods and services are going to be produced, less economic activity. And oddly enough, to layer this over the top of the rest of our conversation, that means that there's going to be a dollar shortage, or at least a dollar cash flow shortage outside of the United States, while at the same time, inside the United States, there could be an abundance of dollars chasing goods and services.
Right. You can have the dollar depreciating in purchasing power inside the U.S., but still strengthening versus the rest of the world currencies.
Correct.
I don't see how the economy couldn't go into a recession with an economy that is this hyper leveraged, this dependent upon basically, practically costless debt. So many companies are at the highest leverage levels they've ever been in history. And of course, when rates go up, their debt service costs go up. So, we could really have a perfect storm of recessionary factors converging here all at one time. So let me just...
You mind if I throw you a curveball?
Absolutely.
I agree with the premise of what you've been saying. I think the Fed raises rates, the market goes down. But I think there's an interesting theory that Brent was talking to me about the other night when I had dinner with him in San Juan. And I want your audience to kind of, we'll think this through the thought experiment, because it kind of offers a different view. And, there are no certainties, there are only probabilities. So I think it would be wise for your audience to take what we're saying, try to figure out the probability of that outcome coming to fruition, and then take what Brent's saying and then kind of weigh the probabilities there. So what we were talking about is just what happens domestically, right? So interest rates go up. That means stocks most likely go down, PE compresses, and then there's this rotation from growth stocks into value, and those growth stocks have been what's been really driving the market overall. So then you have this crash in the market. Then what does the Fed do? Well, let's just assume that the result or the catalyst was raising rates. Okay. If you're a foreign corporation, let's say in Colombia, you've got a lot of dollar denominated debt. So let's say that you've got to roll over that debt, but now you've got to do it at an interest rate that's even higher. And your dollar cash flows have really gone down because of what's happening in Europe and Australia, where they're taking this draconian approach to the, we'll call it the cerveza sickness. So this is decrease, and this is what the Euro-dollar futures curve is predicting. So we have a decrease in global economic growth. That means a decrease in dollar cash flow, but they still have their dollar loan payment every single month. So then what do? Well, they most likely take some of their Colombian pesos that are on their balance sheet to go into the FX market to buy dollars to service their debt until those dollar-denominated cash flows go up. Okay. Well, if you're a Colombian investor and you're someone that's like, let's say, a Warren Buffett type in Colombia, you see this happening and you're like, wait a minute, this is not good for peso-denominated assets. This means that although they may go up, we're going to get a big inflation spike here like they saw in the United States because all of these corporations and maybe sovereigns are trading their pesos for dollars to service this dollar-denominated debt because of the lack of dollar cash flow. What do you do in that environment? So I think that the Warren Buffett type might look at that and say, man, I'm just going to take my $100 million worth of Colombian pesos and I'm going to buy the U.S. stock market because I'm buying a dollar-denominated asset, and I think the Fed's going to come in and do something. And even if they don't, yes, the stock market might go down, but I think the Colombian peso will go down even further relative to the dollar. So I'll have a little bit of a hedge there, even if the nominal value of the stock that I purchase goes down. And therefore, you could see a lot of capital flowing. If the Fed raises rates, you could see a lot of capital flowing from offshore, from the Eurodollar system, let's just say, into the United States to buy stocks to do the Fed's bidding for them. What do you think about that?
Yeah, so I think it's definitely a potential. And actually, I've had that same conversation with Brent, which I think we need to sort of count on some of that happening. Question is, could it be enough to offset the, just in the U.S. alone, right, since the pandemic hit? I think it's something like over 10 trillion in stimulus has been pumped in by both the Fed and the federal government.
Yeah. So the main takeaway there, I think, for the viewer is you have to understand that we're dealing with complex issues. It's not black and white. And you have to also understand we're dealing with cross currents that are at play at all times. So it's not whether we're going to have, stock market crash or the stock market boom or whatever. It's these forces are at play constantly, like these tectonic plates. And we just have to figure out which one has the most power at any given time. And I think that's the prudent way to think through this, regardless of what the viewer's conclusion is.
Absolutely. And it's funny, you took the words right out of my mouth there with cross currents. So as I say often in these videos, I think this is one of the most treacherous times in living history to be an investor. And it's certainly one of the hardest times to kind of wrap your brain around and feel like you can, predict with confidence what's going to happen next. And I come back to a point that Jim Rickards made at the panel that I
when we were in New
moderated
Orleans.
in New Orleans when you were down there. Yeah. And you were very kindly going to pitch in for Jim when we couldn't find him, but he did show up. And his number one advice to people is diversify. Right. He said, look, the diversification, especially in this type of environment, is your friend. That's what's going to save your bacon if your primary theses turn out not to be true. And of course, history has shown that a diversified portfolio tends to outperform any sort of concentrated portfolio over time. So I would say kind of munge together advice from both Grant Williams and Jim is pick your path. Right. There are lots of good arguments out there that deflation may actually win out, but there's an increasing number of ones that are equally compelling that inflation is going to win out. But kind of try to pick your general path, but then diversify. Right. And we were talking a little bit earlier in part one, George, about, okay, well, we've done a good job of scoping the problems, but investors still have the real world problem about what do I do with my money? Right. And you were kind enough to call me an expert. I am not an investing expert per se. I feel like, if anything, I'm sort of an expert of experts, many in the way that you are, where I know a lot of the people out there who are extremely smart on these issues, and a big part of Wealthion and your channels is bringing that in front of people. And then a big part of what Wealthion does is then connects people with financial advisors who look through a similar lens and are translating those insights into an actual actionable plan. Right. And given everything that's going on right now, I do think that the number one thing to focus on is risk management. It's not an environment where you're trying to swing for the fences here, because as you and I talked about, there's so many risks out there, and it's just so murky because of these cross currents. I think you really, at this point in time, capital preservation outweighs reaching for growth. And I'm just going to list a couple of what I consider to be sort of best practices, having talked with a bunch of smart people. And if you want to add anything to this, George, I think the audience would be really appreciative of that. Again, this was taken from Grant's interview last week. The assets that have benefited most up until now are highly likely not to be the ones that are going to benefit going forward. So, expect to see sort of a change in regime in terms of which asset classes are going to be outperforming. You and I spent a lot of time talking about inflation, and from an economic standpoint, at least, you gotta figure out how to protect against it. And you and I were talking about finding investments that give a yield, and ideally give an inflation adjusting yield. And that can be income producing real estate, it can be tips, it can be deep value stocks that are priced reasonably that issue dividends. It even can be T-bills. Hard assets, obviously things that have intrinsic value that can't be inflated away. Commodities, a huge part of that. And you mentioned gold and silver, and some people would throw crypto in there as ways to sort of protect against dollar devaluation. I feel much more confident opining about the precious metals and the cryptos because I understand them a lot more. And the cryptos, so much speculation has gone into that place. They might be very good protectors against dollar devaluation, but maybe only if you get in at a more rational price than they are today. And I don't know what fair value is for those, so I'm not going to tread too much in there. I think too, you need to have some positioning against a market crash. And we talked about the importance of the optionality of cash, even though it hurts to hold it in an inflationary environment before a market correction happens. Hedging is super important in terms of risk management. And most people might be somewhat familiar with the term, but very few people are practiced in actually deploying it. And this is where a professional advisor can be super helpful in looking at your portfolio and using hedges as insurance, the same way that you put in fire insurance on your house to protect you in the unlikely event that it burns down. And then last in that bucket, volatility. Volatility right now is about the only asset out there right now that is negatively correlated with the markets. Everything else is trading in tandem, and volatility can give you some really powerful protection. You don't need a lot of it in your portfolio to give you that protection.